Management to Arvind. The case for a chat here being their strategy for unlocking value, the demerger timeline, charting the road ahead, and plans for the textiles as well as engineering business. Kulin Lalbhai, who's the executive director of Arvind, joins in with his perspective on the business. Great to have you on the show, Mr. Lalbhai. Good to have you this morning. Everyone is eagerly awaiting for some guidance when it comes to the demerger plan. What is the timeline for the same, especially, the plans that you've laid out in the textiles and the engineering business?
Yes, our demerger process is underway as we speak, and it will be complete around the August-September timeframe. So that's when, from the current one listed entity, Arvind Ltd, we will have three listed entities. Arvind Ltd, our core business of textiles and some incubation businesses will be in that listed entity. Then we will have listed entity. Then we will have Arvind Fashions, which is our brands and retail business, and our engineering business. So we will have three separately the businesses post the demerger.
Kulin, that's a really nice jacket that you're wearing. Is that a homegrown brand? Is that Arvind Fashions?
Yes, I do tend to wear a lot of product, our own products whenever.
Tell me, how is it then that you're looking to create value from this entire demerger process? And when is it that we can expect to get, for it to get completed?
Yeah, so the whole idea behind the demerger is we believe that focused businesses that, in a way control and own their own destiny end up creating a lot of value in the long run. And we have seen this with our real estate business, which is a business called Arvind Smart Spaces, which we demerged close to 3 to 4 years ago. And in a short period of time, that business has created disproportionate value. I think having teams focused on their own outcomes with very clearly laid out value creation strategies always, works in the long run. And, for shareholders, obviously, everyone can self-select into whichever business value creation story makes them more excited. So I think we feel this is a great move for the business to, really unlock animal spirits and create value over the next 4 to 5 years. And we expect, as I said, the process to be completed around the August-September timeframe.
Kulin, morning. Nikunj also joining in. Kulin, when I speak to some of our common friends who understand your company much more than I do, the sense which I come back with is that, look, the brand business has great potential, but it's a tough business to be in. And it's a business where, if you look at the Arvind experience, it's been hot and cold. There are some brands where you managed to scale up, but there are some brands you've not really successfully managed to scale up. So do you think the brand business has great proposition, but you should not expect linear growth and great numbers initially?
No, Nikunj, in a way we've been incubating this business over the last decade, because the brands business, when a brand is initially created and it is scaling up, most brands go through a negative cash curve because most of the investments in people and in advertising are upfront. And over time, a lot of operating leverage kicks in. The great news with our brands business is that it has reached a high level of maturity. And that's the very reason that we believe that as an independently listed company, it can create a lot of value. So, if you look at our portfolio today, we've got several brands which have reached a very large scale. 2 of them will be more than 1,000 crore brands on a standalone basis. There'll be another 2 to 3 which are, at that 500 crore mark. And, brands, when they reach that kind of scale, anything above the 300, 400 crore mark, tend to have double-digit EBITDA and return on capital employed above 30%. So, we've kind of incubated a lot of brands over the last decade. We've got 4 to 5 brands which have hit high maturity. We expect another 4 to 5 to hit maturity over the next couple of years. So what you are seeing today is, a business which is around 4,000 crores, growing at more than 20% year on year, which we expect it to over the next 3 to 4 years as well. But, as the operating leverage kicks in the business, we expect the bottom line of the business to grow disproportionately. So we feel that the business can comfortably deliver 150 basis points of bottom line improvement year on year. So we feel the next 5 years of the business are going to be very exciting.
Here I have your EBITDA margins for FY17. Let's use that for reference purpose because that's the data which that would be a starting point. Your EBITDA margins were at 5, CE was at about 3.7%. So when do you think they will move into 8 or 9%? Will it take 2 years? Will it take 3 years?
As I said, you know, we believe the glide path for the business is hitting 150 basis points of improvement year on year. That's what we've been tracking this year as well. If you look at the first 3 quarters, you know, that we have delivered. So we are on track, you know, on that guidance, which is a growth of more than 20% and the bottom line growing by 150 basis points. And you know, the return on capital employed in this business grows disproportionately once the bottom line tracks up.
So you spoke about how, you know, some brands are at a maturity stage, some brands are maturing. I just want to understand what this does for your brand portfolio, because working out the brand cycle essentially means that you need to also constantly bring about new brands and maybe spend more on brand innovation, on marketing and sales. And how much do you think you would allocate to that process as a percentage of sales going forward, and what would that do for your margins as a whole?
No, see, we are very mindful of how one optimizes a portfolio. And what we constantly look at is what are where is the market headed and where are big bets going to create disproportionate value. So if you look at the segments which we are operating in and which our company dominates in, you know, segments like men's casual wear, segments like innerwear, segments like kids wear, segments like beauty which are emerging, we have created a portfolio which is going to take advantage of these market shifts. The second thing we keep in mind when we take on an opportunity is that the scale and size of the opportunity needs to be large. So for a company, you know, which will be $1 billion brands in retail player, we will want to get into opportunities which achieve a certain level of materiality, a 500-600 crore number in a certain period of time. And obviously, we will constantly ensure that if a certain hypothesis doesn't prove out, we would not end up spending excess resources on an opportunity of that sort. So I think you dynamically optimize your portfolio. But overall, when you have a very large part of your portfolio being mature, the investments which you make towards the emerging part of your portfolio become very small compared to the overall size of the business, which is what is playing out now.
So, you know, in just the extension of what you were just talking about, what is the big strategy going forward? I mean, today we're living in the world of the e-commerce space, right? That explains the creation of mammoths like Jeff Bezos. I mean, I myself don't recall the last time that I actually went to a brick and mortar store and shopped for clothes or shoes or anything, right? It's just about everything online. What's the big vision that you at Arvind have to take your brands from the brick and mortar model to take them online?
So, you know, we are a brand house. We are not a retailer in that sense. So for us, every new channel is a great channel for our brand. So like Arvind would be perhaps the largest partner of any physical mall, you know, we would also be the largest partner of any .com. So in a way, the beauty for this is, for this channel shift for us is that it's expanding the market. It's allowing us to take our products to so many more consumers because we're not limited by physical space anymore. And Arvind has in a way taken, you know, already 10% of our business is online. And the way it is growing, there will be a time where 20% of our business will be online, and it might keep increasing. And beyond, you know, selling through traditional marketplaces, we as a company have also made a very bold bet and invested in omni-channel, which is a concept which says if you link the online and offline worlds, you end up creating a lot of value for your customers. So imagine a world where you can open up an app on your smartphone and literally see the inventory of your favorite neighborhood store, which you can, you know, pick out on your phone and ask the store to hold it for you, and on the way to the movie, you try it out in the store. You know, that's the world of the future where the online and offline worlds will merge. And that's where Arvind has made a lot of investment in talent and technology, so that we are in a pole position, you know, once the omni-channel reality comes to fruition in this country. And also the pure online marketplace is an opportunity which is scaling up very, very quickly as well. So for us, you know, the world of the future is an exciting world, because you're going to be able to develop brands very differently, and you're going to be able to get them to a much broader market. So that's the way we look at the future. It's a multi-channel world, so our multi-brand portfolio should leverage it.
We've spoken about the textiles business. I think we've spoken about branded apparel in detail. It's good that you're kind of breaking down the businesses and making the business model a bit more simple. Engineering, you know, at 15 times EV per EBITDA going forward, FY20 that is, what is in store in terms of the order inflows that you expect, and also the kind of expansion plans that you may have here?
So the business is today on a very strong footing. It's a very healthy pipeline. In fact, every year we have been completely sold out on our capacities. So it's a 200 crore size business with a 30% EBITDA margin, very healthy cash situation. And the good news is that the business has developed very strong, deep relationships with our clients. So as they get into very large capex plans, we tend to be the beneficiaries, because not only are there greenfield projects, even replacement of their equipment comes to us. So with the strong accreditation and strong brand relationships, we expect a very healthy pipeline. And we've also put in place an expanded capacity which is coming online. So, you know, we are very confident of this business growing at more than a 20-25% CAGR with a very healthy pipeline of orders.
Kulin, good chatting with you. Thanks so much for taking the time out and speaking with us today.
Thank you.